So I recently shot a video explaining how important diversity is on your credit report, explaining how detrimental it can be if you have a thin credit profile or a singular credit profile, in the sense that you only have one or two different trade line types on your account. For many different lenders and many different situations, this can be a major turnoff and still make you look risky even if you have a great credit score. Many of you may have watched that video and have been thinking, well, if that's the case, how do I get around hard inquiries? If I apply for various different loan types and credit types, how do I deal with the fact that I'm going to likely get hard inquiries in most of those occasions? We're going to cover that in this video. We're going to talk about what hard inquiries are, what the different types of inquiries are, how they affect your credit score, how you need to look at them, and how you need to navigate building your credit report out around them and with them. We're going to cover that in this video. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So you think about inquiries. We have two different types that most of you may be familiar with: soft inquiries and hard inquiries. You think about driving by, doing some kind of inspection on a property. You have a soft inquiry where you're driving by and checking out the property from the outside and passing, versus going inside and going through every nook and cranny on that property. That's an analogy for soft and hard inquiries. Soft inquiries are not reported on your credit report, and they can be conducted as much as you want them to be. They have no impact on your credit score. They have no calculation or relevance in that capacity. It just gives lenders at least a glance or curb appeal look at what your credit score looks like and your score looks like. And in many cases, this may be enough for lenders to at least pre-approve you, or in some cases, outright approve you for financing or lending or credit. Hard inquiries are an in-depth look at your credit profile. They're looking at every single capacity of that particular bureau's data points on you, or multiple bureaus' data points on you. They're looking at the whole thing, top to bottom. These are accounted for on your credit, on your FICO scores, and on your Vantage scores. They are accounted for. They are reported, and they typically stay on your credit report for up to 2 years at a time. Now, what's important to understand about inquiries is they're unavoidable on your journey to credit. Many people I've run across in my financially professional career have this outright fear of hard inquiries. They will literally ruin themselves credit-wise because they won't build credit because they're scared to get a hard inquiry, which is crazy. But for some reason, they've run across this as this major boogeyman in the credit space, to the point where, again, they will shoot themselves in the foot by just not having credit at all. Credit inquiries are, if you're strategic and know what you're doing, they're not that harmful. So we just discussed that they stay on a credit report for up to 2 years. One major factor to keep in mind and be educated about is that FICO only counts your inquiries, hard inquiries, up to 1 year within your score. So even though they're on there for 2 years, they're not really being accounted for after the first year. And that's fair to say, because when you think about it as a lender's perspective, if you apply for a credit card 1 year and 2 months ago and you're applying for mine now, that's not a real indicator of any major risk or that you're desperate for credit. That's a pretty decent spurt of time to get a new account. In many cases, even 6 months is reasonable to get a new account. What happens with hard inquiries and where they really start to matter is when they're compiled together, and they're particularly compiled together from areas where you don't have to rate shop. I'm about to explain what that means because this is very important. This might be the biggest nugget in this video. Hard inquiries are an indicator of your need or your desire for credit. And when you have too many of them in a short window of time, certain circumstances of having too many at one time, then they start to hurt you and make a lender skeptical about you. When you have a certain type of inquiry, meaning, let's just hypothetically say you are going to apply for a credit card. In this case, we're going to say multiple credit cards. What happens with a lender is once those inquiries start to show up and report on your credit report and they see it, when you think about how credit cards work and what they're typically used for, it's hard to justify why you need so many at one time. Stop and think about that from a lender's psychology. It's hard to justify why you need 3 or 4 or 5 credit cards at one time. One time being same day, same week, same month, even 2 months. Why do you need so many credit cards in such a short span of time? Now, obviously, you're watching channels like this, content like this. Your mindset is usually developing your access to capital to put it to work to build wealth. So we know that this is a thing, but lenders don't really look at it from that psychology. Believe it or not, those of us who function in this space, in the finance space, we're a niche. We're a minority. We're rare. Most people don't get credit cards to leverage them to build wealth. They don't. They don't even know that's a thing. So lenders are focused on a broader market of borrowers. So when they see you applying for multiple different credit cards or similar revolving products in particular, it's a little nerve-wracking for them. And it could be enough for them to outright not consider you because it just looks desperate. Now, there are circumstances where having multiple inquiries on certain types of lending is not looked at in the same capacity. And this is where the rate shopping comes into play. This is when you're applying for multiple, typically installment loans, not as much personal loans, but auto and home loans. These on average, and even student loans, on average can fall in the category of rate shopping loans. FICO is actually, that algorithm is intelligent enough to pick up that you are actually applying for a type of lending product that does require or should have a shopping effect, meaning that basically you are trying to get the best rate on that product. So they expect you to look at multiple lenders. It's different than a credit card. You see what I'm saying? A credit card is access to capital, it's revolving capital, and it's very nuanced. Every credit card is nuanced, so it doesn't serve the same exact purpose. But a home loan is a home loan. It has diversity within home loans, but you're buying a home at the end of the day. The end game is the same. You're buying a home. And the same thing with an auto loan. You're buying a car. You might have various different loan products, but you're buying a car. So it's looked at and assessed for the fact that you're shopping for something that you should be shopping for, which is rates, the best rate on that end product. FICO actually accounts for this. And older FICO models will actually allow you to rate shop up to 14 days on a mortgage or auto loan or even student loans. Newer FICO models, so maybe think 9 and 10, actually will go out 30 to 45 days of shopping when you are looking for a home or auto or student loan. That means that you can get hard inquiries up to that window of time, and it'll basically look like one hard inquiry. It's for one end product, and you're getting the best rate, and it'll look as if one. Now, it all reports on your credit report. Don't get it confused, but it's only calculated on your score as one hard inquiry. This is the same thing on older FICO models with a 14-day window. It's all going to pretty much look like one hard inquiry, even though it's going to be reported as multiple. The score will account for this, and usually lenders will identify this in their algorithms as well, or underwriting, and be able to tell, okay, this person was trying to buy a home in this window of time or a car in this window of time. So you might have 3, 4, 5, 6, 7 inquiries, sometimes per bureau, but it's not going to be looked at in the same. It looks bad on your credit report to the naked eye because you're trained to look at it that way. But algorithms within the FICO scoring model and lenders and their underwriting and automated underwriting typically pick this up and see it as okay. You have to watch your window of time. You can't be house shopping and getting inquiries for 90 days straight. That's a different beast. But the first 14 on older models, and maybe think FICO 9, FICO 10, up to 45 days in some cases, you can shop for a car, a home, or student loans, your installment loans, not personal loan, but other installment loans. And it typically be calculated into your score as one hard inquiry, which is amazing because typically one hard inquiry is about a 2 to 5 point dent on your score, which isn't bad at all. Versus when you get to about the third or fourth inquiry, you start to branch out into the double digits on dips in your credit score. It can get pretty bad. So it's very good that they account for this and allow this flexibility. And I wanted to bring you this education because many of you are frozen on building your credit and building that diversity in your credit because you're terrified of hard inquiries. Quick recap. Hard inquiries last up to 2 years on a report, but are only calculated up to 1 year on FICO scores. You can shop On the installment loan side, particularly home, auto, or student loans, up for anywhere from 14 to 45 days, depending on the FICO scoring model accounting, and not damage your score beyond one hard inquiry, even if it's multiple, because they expect and calculate that you're going to shop for the best rate on these products. That means that it's safe for you to go out. When it comes to credit cards, the tactic that I would recommend, and I'm going to do a more extensive video on, is where you do your research and find credit card companies that are pulled from certain bureaus, and you look for 2 to 3 of them that pull from different bureaus, and that way they're only seeing one bureau's inquiries. So you might be pulling one bank from here, one credit card, one bank from here, and one credit card, one bank from here, and that way you're able to build out your profile faster, thicken it up, and you're getting inquiries on different credit reports. And that lender can only, if you do it in a short enough window of time, that lender can only see what's going on that report in the last 30 days, not current. Just a quick hack for you that are trying to stack your credit cards, which I'm a huge advocate for. That's how you can minimize your inquiries. And those of you who are just general borrowers out there, stop being terrified of inquiries. Be strategic. Watch this video, study it, and then apply that strategy to whatever you're looking to accomplish with your credit. But you need a sturdy, thick, and robust credit profile at the end of the day if you want to be a high quality FICO high flyer. Thank y'all for tuning in. I enjoy bringing you this content. As always, I want y'all to stay focused, stay in motion. I'll see y'all soon.